So one is what we call the short iron condor. So it's basically a debit spread and used for those specific stocks that tend to have a tendency to have big price spikes, either up or down. So like that Roku or maybe Nvidia or something like that. Second one is what we call the iron condor, the long iron condor. So this is a credit spread where you're selling time and volatility to take advantage of the volatility crush. You know, as volatility goes up, and then after the announcement, it has what we call collapse or volatility crush. So we sell volatility. The third one is also a volatility crush play. It's what we call the long iron butterfly. So again, a credit spread. And then the fourth one is kind of become our go-to. This is what I call the double lightning. So it's a debit spread, but it's also one that's great because it can be used for volatility crush plus a post-trend trade on your earnings trade. So it's got a lot of flexibility to it. So this earnings strategy that we'll talk about has become our favorite kind of go-to strategy. And again, it comes back to it's very low risk, has potential for high reward, and it's very flexible. And when I say flexible, because you can stay with this particular strategy the way it is for a post-earnings trend. So the double lightning is basically a double calendar. So what is the double calendar? This is a really great option structure that provides that non-direction, low defined, high reward earnings option strategy. So we don't care about the direction. It could go up or down, it doesn't matter. But what we really are looking for is to take advantage of the high implied volatility spikes and take advantage of selling that and selling time, which also goes to zero into expiration. So we're going to be selling volatility as a spread to capture the elevated volatility levels from the near-term option series versus the longer dated option series. So when we're going into an earnings announcement, we're going to get what we call positive horizontal skew. So that means the short dated duration option is going to have higher implied volatility than the long dated. So we're going to play that spread and sell it. Now the second benefit is there's the what we call the differential in the rate of premium decay. So the theta decay delta differential. And again, the near term short option series. So again, like the implied volatility being high in the short duration, you get a higher positive theta decay from that short duration option. So we're going to be selling the near term option to take advantage of that. And then we get the long dated has less theta decay. So we're playing that delta or differential. And then 3 is the direction. We can actually stay with the trade if we want, and then have a post-earnings trade trend up or down if we want to stay with it. So it's got that additional kind of benefit or profit component. So the long-dated option, if we want to stick with it, we can stay with that, and that allows us to capture that post-earnings trend. So remember, as a company moves into the day of its earnings release, again, its options volatility is going to often reach extreme levels, a lot of times 2 to 3 times the normal volatility level due to all that uncertainty that's surrounding an earnings announcement. Now, again, though, after the earnings release, all this uncertainty is removed and creates what we call a volatility collapse in the options volatility as it moves back to normal levels. So volatility crush.